Hello everyone. So when we look back at the quarter that has just gone by, it has been quite eventful because what you have seen the tantrum of Trump tariffs, then you have seen also the issues relating to hostilities on our northwestern border, and also the earnings season go by for FY25. So overall, when I assess markets at this point of time, the way we are thinking about it is, first of all, when we look at various parameters, growth being one. Clearly, we are in a much more comfortable situation than probably the world is in a sense that India is a largely domestic-driven economy, and the economy is growing. Whether we nudge the 7% rate or we are slightly short of it, but broadly at least it's on a uptick as such. And especially when we compare it with last year. Now, when we compare at the same time the global growth equation, what we are seeing there is obviously an issue where IMF has recently toned down growth projections for global growth, etc. So India in relative terms is looking far better. Then the second part which has happened for markets overall has been that monetary policy has had a sea change ever since December of 24. So from that point on, what we have seen is that RBI has done a slew of steps. You had CRR cuts, you had stuff like variable VRR auctions, etc., to infuse liquidity, followed up with a rate cut and all that. So overall, the situation at a monetary level has been drastically better than what it was, say, a year back. And to our mind, that has been something which has been fairly positive for our markets. And obviously, there'll be a little bit of time for it to filter through into markets in terms of the transmission of the policy and impacting borrowing costs, but at least the beginning has been made. The third aspect, which has also shifted slightly favorably for us, has been the flow part. When we look back into September of last year, when you had two material events happening globally, Mr. Trump's election, and at the same time you had China announcing a meaningful stimulus, almost about 5% of its GDP. The impact was that there was a strong phase of dollar strength, which meant that money actually went out of emerging markets into developed markets. In parallel, within emerging markets also, China, which was largely a market which was not doing much in the run-up to that stimulus, started building in some hopes of an improvement in performance, and as a result of that, within Asia as well, what we saw is money flow out of other Asian markets and move into China. Both these factors led to a large outflow from the FII side, which has actually now started gradually reversing, in a sense that what we're seeing on the dollar index is that has started easing off, and that is also leading to a more balanced situation on the flows front. Domestic flows, as you are all aware, has remained fairly strong. So the negative drag that was coming from FII flows has actually become far more neutral at this point of time. The last part is that valuations have also in that process turned marginally better than what we were in September of last year. If you look back at September, we were probably trading at more than 20% premium to emerging market valuations. And from that point, you had 2-3 events which have happened. One is that clearly, market does its annual roll forward, that it starts moving away from March 25 to March 26 as we approach the year end. So whatever be the growth that we are budgeting or penciling in for March 26, that has actually started showing up in terms of a cheaper number. Second, there was absolute price correction from the highs we hit also, and that has also led to some kind of valuation tone down. To a large extent, all these factors have meant that the froth in the markets has actually drained off a fair bit. Whether we hit a new high or anything of that kind in the near term, it may be a little bit of a question mark at this point of time. Reason being, there is still the uncertainty relating to Trump tariffs, or also in terms of how strong our earnings momentum is, which has been a little bit lackluster because of the base effects of last year. Last year being because of electoral code of conduct and other things, the growth rate was a little bit more subdued. But clearly that is a rear view indicator. So when we move forward and we are going on a growth which appears to be slightly better than FY25, we should also start seeing the earnings filter through. And also do remember that will be aided by the softer policy environment, and that should impact in terms of cost of borrowing for corporate India as well. Both these factors in conjunction should actually help market post at least kind of a double-digit growth going forward. Also do remember that sometime towards the end of this year, again market will do its annual roll forward exercise to move away from March 26 to March 27, and as a result our valuation also look a lot more appealing at that point of time. So whether we gravitate towards fresh market highs in say the next quarter, or maybe it takes about 2 to 3 quarters, I think that is still something left out there because of the various uncertainties that are surrounding us. In another factor that has also played out slightly positively is the ceasefire on hostilities, because obviously there was a little bit of concerns from the FII side when we had this border situation at our northwestern border. And ever since, there's been a, call of ceasefire, and the fact that, that peace dividend has slowly started getting reaped. From that perspective also, what we are seeing in the market is that there is a little bit more confidence coming in from the investing community, especially overseas investors, in terms of looking at India now. So I would say all in all, it looks a fairly positive situation at this point of time, and most of the factors are looking slightly better than what they were, say about 2 quarters back. If there was one thing I would look for a little bit more positivity, I would say it would be the earnings, which I will start looking at from the first quarter numbers, which will start coming out from next month. So that's where I would probably place the markets at this point of time. So that's broadly what I had to say on the markets at this point. Thank you so much for this patient hearing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.